when it comes to plotting out your investment strategy and picking the stocks most likely to perform, what do you look for? Tonight we're going to sort out the fact from fiction and have a close look at getting a return on equity. And to help with the task, we've got investment guru extraordinaire, Roger Montgomery. How are you, mate?
I'm well, mate. How are you?
Very good indeed. Now, the last time you were on the program, you said to me that you'd come in and we'd look at a company, or we'll look at the way in which you actually do weigh up a company, whether you like it or not.
Yeah,
Okay.
I get a lot of questions about, how did I know to buy the reject shop at $2.40? Now it's sort of got to $14 or whatever.
Yeah.
And why did I warn people to get out of Wesfarmers when they bought Coles? And the Wesfarmers shares were trading at almost $40 at the time, and I said, look, they're going to go to 20, and they in fact went to 17, and I, hopefully saved people tens of millions of dollars. But it's pretty easy if you know what to look for, and I guess that's why you asked me to come on the show.
Definitely. You keep saying it's easy. I want you to show us
I'm
how
happy
easy
to do
it is. Okay,
Yeah.
so take it over. What's the first step?
Well, look, I sent you some tables. Have you got those? Are they able to put those up tonight?
I'm sure
Hopefully they will.
Yeah, they will.
But the important thing to understand is return on equity of a company, not the profit. So you can have a company.
And by the way, some people out there will be saying, I've heard the term return on equity.
I'll explain it in a second. Yeah.
Good.
Most of the analysts you have on the program, and not to disparage their work, they do great work.
You never do that.
No, exactly. Their focus is on the earnings of a company and the dividends of the company, what you can get out of a business. But anyone who runs their own business knows that it's often more important to think about what's got to go back into the business to run it, not only what's coming out, but what you've got to put back in. Okay. And so the important thing here, and this table is going to help us. Great. Here we've got a company. So let's look at column 1. Yep. We've got a company that has $10 of equity on its balance sheet, okay? And the for those people who don't know, the equity is just the difference between the asset value. So you bought a house for $100,000 and you borrowed $50,000. So the difference is the equity. It's what you put in, right? So if we have $50,000 and we have 5,000 shares on issue in this business, well, each share is going to have $10 of equity. So that's the $10 of equity in column 1. Okay. Now this company is going to generate a 20% return on equity. Its earnings are going to be $2, which is 20% of the $10 that you can see there in column 1.
Okay, so the 2 over the 10 gives you the 20.
Correct. Yeah. And then the company has decided, in its wisdom, management have decided to pay half of it out as a dividend. Yep. So that $1 is paid out as a dividend. And what's left over at the end of the year is the $10 of equity that we had at the start, plus the $1 that's retained, the retained profits of $1, gives us $11. Okay, so that's the business. Yep. Now, next year, we start the year with $11 of equity. It earns 20% again, which is $2.20 of earnings. Yep. If we make the assumption that the stock market doesn't change in terms of how much it likes this company, so it's always willing to pay 10 times the earnings. Well, in the year 1, it'll be trading at $20, which is 10 times the $2 of profit in year 1, and in the year 2, it'll trade at $22, which is 10 times the profit of $2.20 in year 2. Yeah. Okay, now here's the thing.
All you're basically doing is you're taking the earnings, you're multiplying it by the PE of 10. Correct. That gives you $20.
All I'm trying to do there is try and explain to people how much the shares have gone up. Now, you only want to buy, this is what I do, okay? I only want to buy businesses that for every dollar they retain, for every dollar you don't get as a dividend, every dollar that's ploughed back into the business, you're going to get more than $1 of market value. All right, now, because
and that would be reflected in the share price, you're saying?
Well, in that example, it was.
Yes,
if we go back to it, if we go back to it, what we'll see is that the company retained $1. So you didn't get you got $1 of dividend, but the other $1 you didn't get. It stayed in the business. Yeah. Now, because it was generating 20% on that dollar, the share price went from $20 to $22. Okay, so the dollar that was retained was converted into $2 of capital gain. That business, you actually don't want it to pay you a dividend. Now, most people get that wrong. Most people think, well, I want to get the dividends. If a business can get 20% return on its equity, well, I don't want the money. What am I going to do? I'm going to put it in my bank account. I'm going to get, one of those Advantage Saver accounts, which get 1/10 of 1% interest. That's why they call them Advantage Saver accounts. A big advantage for the bank, right? Not for us.
Oh, you're doing commentary here. You're doing comments around here.
Sorry about that. Sorry, I'll leave those jokes to you. Okay. But I don't want the money. If you've got a business that can get 20, 30, 40% return on equity, you keep the money. So what I try and do is find the businesses with high rates of return on equity that are keeping a lot of the profits and getting high rates on the incremental earnings, on the retained profits. And businesses that can do that over long periods of time, their share prices do really well. Now, what happened with Wesfarmers was they went out and paid too much for Coles. So Coles had $4.3 billion of equity. Remember that table we just went through?
Yep.
They had $4.3 billion of equity and Coles was generating 27%. Attractive. Now, if you want a 13% return on your money, well, you'd be quite happy to pay double the equity because the business was generating 27% on the equity of $4.3 billion.
Yep.
I want half that return, so I can pay double the equity. I could pay $8.6 billion or $9 billion for that particular business.
Yep.
Wesfarmers paid $22 billion for Coles.
And what was the figure that you said they could pay?
I thought it was worth 8.6.
Okay, and they paid
8.6 maybe.
Okay.
If they were good retailers, if they were really good at what they were doing, and they knew what they were doing, and they could get a higher rate of return on equity, well, you might stretch the payment to $10 billion. But you wouldn't pay $22 billion. So when they pay $22 billion, what you know is the return on equity is going to drop from 27% to 3%. I don't want to own a business that generates 3% because it's worth less. And the reason it's worth less is that dollar that it retains isn't going to be turned into more than $1 of market value. It's going to destroy wealth. Okay. And the share price, it's funny, for all the apparent, for all the brainy people in the stock market, all the people that know so much about it, they seem to catch on a bit slow. So it takes a while for the stock market to catch up. And that's how I knew that it was going to fall.
But the people who said this is not a bad deal, they were all looking at the idea that the market would keep advancing, Westfield's share price would increase. Wesfarmers would increase, and the dividend would be there. And they thought, looking at that criteria, it wasn't a bad buy. But clearly, on what you're saying, this is a far more important point for making a decision on a company.
I'm always very, very cautious when there's a lot of enthusiasm and a lot of popularity around something. You can't buy what's popular and expect to make a lot of money.
Well, let's go to Myer, because you've been quoted a few times.
Myer is very, very popular. I've been in all the papers and on, and all of your competitors, shows talking about Myer. It's an interesting story. They paid $1.4 billion for Myer 3 years ago. They used $400 million of their own money, of equity, and they borrowed $1 billion. Okay.
This is a private equity outfit.
This is a private equity outfit, and the Myer family as well. And what they did in the first year that they owned it, they sold a 299-year lease on the Burke Street store in Melbourne for $600 million. So they got cash in of $600 million, and then they had a clearance sale, a big clearance sale, and I think they netted about $100 million from the clearance sale. Might have been a bit more than that. So they got, say, $700 million of cash in the first year, which they used to pay themselves back. So they got Myer for nothing, and it generates $3 billion of sales. So within the first year, they paid nothing for it. They got free carry.
These are the people that want to manage my money. They're good.
Well, they are very good at what they do. Now what they're asking you to do, so they paid 8.5 times EBITDA or for the business, or 8.5 times EBIT, I think it was. They're asking you to pay 11 times. They're asking you to pay $2.9 billion for the business.
And there's less assets in there now.
It's got $738 million of equity. Some of that equity is goodwill. There's also some, and they're saying that based on the forecast profits, I think they're going to earn $160 million or thereabouts. Based on the forecast, which there's a few capitalised expenses in there. There's that they've taken out rather. There's a few fees and incentives that they've taken out because they're non-recurring, all that sort of stuff. But based on those numbers, they're going to generate, say, 27, 28% return on the money. If they do that, then it's worth $2.90 a share, okay?
That's the figure you've come up with, $2.90.
That's the Wesfarmers $20 figure when it was trading at $40, So they're asking for $3.90 to $4.90 a share. I reckon it's worth $2.90. Now, it might go up, it might list and go up, but when Virgin listed in 2003, I said I wouldn't touch it, and that was at $2.50. It's now trading 50 cents. Now, in the short term, the stock market is a popularity contest. It goes up and down based on what's popular. So 146,000 people have applied for a prospectus for Myer. That's popular. But I don't want to be where things are popular. I want to go forward and ask myself, well, what's it actually worth? Well,
so it's a popularity contest in the short term. So what is it in the long term?
In the long term, it gets it right.
It's a weighing machine.
It's a weighing machine. It follows the value. And in 5 years' time, the value of Myer, I'm pegging at about $3.90, $3.90, which is what they're asking you to pay today. are you prepared to pay $3.90 today and wait 5 years for the value to catch up? I think there are better opportunities in the market.